Peter McGuire also joining us this morning. Let's just touch base with him on what's happening in global equities right now. Peter, good morning. The yen, let's just start off with that, climbing to an 18-month high now. So that's where we're seeing it. And of course, we've had the BOJ also in focus this week. How are you looking at some of those cues?
Well, good morning. Thanks for inviting me on the show. I think everyone was a little bit surprised as far as the BOJ and just, sitting on their hands and doing absolutely nothing, which in turn, we've seen that yen really rocket. And it's been a glory trade. It's up around the best part against the US dollar, I think about 5.5% this month. So that's a wonderful appreciation. Traders are all over it, and I'm not sure where it's going to go over the next couple of weeks, but it's certainly been one-way traffic. So, the yen is a very interesting trade as, we're keeping a very close eye on it.
Good morning, Peter. My question relates to what the Bank of Japan really did do or didn't do yesterday, which is they said they're not going to spend more money to go around buying more exchange-traded funds and basically become a bigger owner of the Japanese stock market. And my question to you, Peter, they already own indirectly 9% of the Japanese stock market, and they're not able to control it from falling. What happens when the Bank of Japan tries to sell these shares? Who's going to buy this stuff? Are we going to run into a liquidity crunch?
Well, that's a very good question. First off, will they sell? And I think that they've got to be very mindful as far as where the yen is and where the equity markets are. That's a very, very interesting dilemma. I'm not really sure whether they will. I think it'll be a wait-and-see approach. They're seeing weakness across a lot of those markets leading into probably the next few weeks. And if that underpins weakness, I'm sure that the Bank of Japan won't sell. It just depends on the economic situation globally. And, it's a hard one to speculate on. Very, very interesting dilemma.
Peter, I'm just looking around the world, and I'm seeing as if the stock markets, leaving countries like India where the government doesn't interfere with buying shares, but in most of these countries, the shares are propped up, including countries like Malaysia and Singapore, because the government, through their provident funds and their employee PPFs or khazanas or whatever else they have, just simply hold all the stock. I'm just wondering if all these share prices just are completely artificial, starting from Japan and then going down to a number of these countries.
Well, in some ways it is, but then again, if you're looking at pension funds and you're looking at, workers and government, I suppose a mandate would be, if you're not going to buy hard assets in the sense of, real estate or other things, then you've got to look at equity markets, and they look at companies and they see that as a shore up, and certainly they pay, healthy dividends, and they look at, the growth and the performance of the country. So they're backing that, and they're backing their own people, and there aren't many other places to employ capital. There's no return if you're looking at bank bills globally. There's negative rates in a lot of those mature markets. And then you look at, the fragility as far as the commodity sector. So they've got to look at, the companies internally. And that's probably their strategy.
Peter, I wanted to also check with you what you think is going to happen to metals prices in the short term and the long term. I was looking at Chinese data, and they actually produce 70 million tons of steel in March. That means they're in target to produce 840 million tons if they keep up the 70 million tons. Now, the Americans and the British, if I have understood correctly, are going to put import tariffs. India's already put import tariffs. What's going to happen here? The iron ore prices are going up because of this, but who's buying all this steel? Or are the Chinese just trying to keep their factories running irrespective of whether it makes any money or not?
Yeah, I think so. I think they just want to keep them running. They'll stockpile them. The warehouses will be full, and that seems to be the current situation. Some of the production numbers are absolutely monstrous. But they need to be buyers of them. It's been a very, very good time to buy iron ore, of course, which is one of the major components as far as steel. And then you're looking at cheaper copper prices with the commodity sell-off. They've been able to buy strategically very, very cheaply, and it's been, the old story. It's not as though you're buying soybeans or corn and or other perishable items as far as commodities. You're buying hard items like steel that really, as long as you keep the thing dry, you've got it there for many, many years, and as long as you can warehouse it, you can sell it when the market does recover, or if it does recover over the next matter of years. So it's not a bad way to do it. That seems to be their strategy, and they've done it time and time again.
Right. Peter, so right now then, now that the attention from the central banks has of course, been shifted post this week, what are you going to be focusing on going ahead? We've got, you know, we've already been talking about the currencies. We've got oil also near 46, commodities taking a bit of beating. You know, what are you going to be watching out for?
Well, I'm worried about the US dollar. I think that's, we've seen where it's gone, and it's had a fairly healthy pullback over the last couple of days. I'm also conscious as far as gold, what's happening there. We're keeping a close eye on that one. The crude market with the upward trajectory this month has just been an enormous rally to the upside in the last matter of weeks. And with the way the momentum's going at the moment, you know, I see a $48, $49 handle for Brent and WTI. We're just keeping a close eye, as I said, on the US dollar, and that'll give us a lot of directional, give us a clear understanding as far as what's going on. And then, of course, you're looking, you know, where US dollar versus gold. And I think there's every chance you could take, you know, close to that 1280, 1290 number sometime in May.
Peter, what do you make out of the sell-off in global markets yesterday? It almost looks to me that the markets are so skittish because whatever was happening in Japan is very Japan-specific, that the central bank has turned into more of a sovereign fund manager of some sort and really doesn't relate to global stuff. But on the other side, most global markets almost behaved as if there was some financial crisis coming through.
Well, it's been a big week. I mean, we've been waiting to see what happened with Yen earlier in the week, and then we saw what happened with Japan. And I think that put a lot of trepidation as far as traders were concerned. They, you know, a bit of profit taking, and of course, they're mindful as far as, you know, what central bankers are trying to do, the overall strategies involved. And I think that's added a little bit of fear to the market, and it was just sold off. You've got Japan also with a holiday, and it's not a bad idea. If you're going to see a market correction, you come out with something, give it a couple of days to digest and sell itself down. And with a national holiday, that could have been one of the reasons. We're keeping an eye on China. I mean, everything seems to be red this morning across the markets. Hong Kong's down. It's interesting to see what happens as far as the day progresses and into Europe, and what happens, of course, with India. So I think it's going to be it was a flattish sort of sell-off market in the States this morning. I was watching that early. So I think that will probably continue over the next day or two. We've had a pretty strong uptick, and now it's a little bit of correction time.
Yeah, Peter, usually we've seen that if there is asset bubbles, they never end till the time there is massive destruction of wealth. I just want to read out something from Bloomberg Wires, which says speculators traded $261 billion in Chinese commodities in a single day. That is equivalent to the entire U.S. equities market. What's going on, Peter? I mean, it looks like there's too much money in China, and it's chasing stuff that doesn't really seem to make much money. How will this end? I guess for a longer-term investor, is it going to be a massive correction, or the bubble just grows bigger and bigger?
Well, I think the bubble grows bigger and bigger, but the other side, of course, is that you're buying the stuff cheap, and it's been cheap for, really the last year, and they're realising that this upward tick as far as crude prices, the Chinese are keeping a close eye on that, and they're mindful that if it hits that $55 level, everything will make it look expensive compared to what you're buying at today's rates. And, you've seen iron ore, you look at copper, it'll drag everything up. If crude gets a recovery and you hit 55, we get into some sort of, all you've got to see is a couple of refinery outages. You've got to see, some weather outages with hurricanes. If you have some geopolitical in the Middle East, anything like that as far as disruption is going to underpin the market, and it's going to move stronger. Also, you've seen that weakening of the US dollar. So if that all plays that perfect storm, you could see crude rally stronger, and that's why they're, jumping into commodities. It's just it's cheaper today than what it will be tomorrow, and that's where they're looking at return.
Peter, in all this, just a question about India now. I mean, this almost seems like an oasis. The government doesn't interfere. We don't have a sovereign fund. We don't prop up the markets. The government largely has a pathological aversion to stocks, so no provident funds, no pension funds are allowed to invest, except if you select yourself in a defined contribution, which is the NPS. Is India then perfectly poised for a large inflow, given the fact that this is one of the few markets that's not propped up by any governmental interaction?
Well, exactly right, and I think investors look at that. They also look at the underlying, IMF numbers and forecasts. They're conscious as far as where India's placed over the next years ahead, and in a lot of investors' eyes, it's a bargain, and it's certainly got plenty of upside. I think the only point is if Europe comes through okay, if the US maintains its sort of numbers over the next 12 to 18 months, it's going to be a very, very strong period of growth for the Indian economy, really for the next 3 to 5 to 10 years. So that's where the market and investors look at those frameworks and understand that it's fairly transparent.